How do we know when is the best time to retire? And how much do we need in our investment portfolio to make sure that we're retirement ready? These are the questions I often hear from my clients, no matter if they're 30, 40, 50, or even 60. But there's actually no magic number or formula for you to determine when you should retire, because it's really a balancing act between how prepared you are financially versus the other 4 considerations that I'll be going over in today's video. And if you stick around until the end, we'll be going over a sample scenario and showing you a simple way to calculate how much you need in your portfolio to be retirement ready. So the first time is when your work is taking a toll on your health. During your working years, you probably accumulated stress, lack of sleep, and maybe skipped some of your lunches to get work done. And all these will accumulate in your body and can lead to physical or even mental illnesses. And if you continue working and overlooking your health, then chances are your health will deteriorate at a much faster pace. And at the end, even if you've accumulated enough money, you might not have the health or energy to enjoy the things that you love to do. And if you don't love your work and you're just really there to get a paycheck, then it's even more important that you have a clear idea on how much you need to retire. And once you have a clear idea, then you can start working towards it. So now cutting your expenses seem a lot more purposeful, because you're not just sacrificing your current lifestyle for nothing. And if you have the feeling that work is taking too much of your time, maybe it's time to consider scaling down and having more time to start reconditioning your health by focusing on your diet, exercising, sleeping, getting enough rest, and maybe even some meditation to de-stress. And if you're still in the accumulation phase, then make sure you're more intentional on how you spend your off days or weekends, and spend some time on activities that will help you de-stress and getting more rest, because your health is one of the most important things when it comes to your happiness. The second sign of when you should consider retiring is when you realize the time with your family and your friends are going to be limited. In our previous point, we're more focused on your own health, but we also cannot forget about the health of the people we care about, because you have to realize that our friends and family are also aging as well. And if there's a list of things that you've always wanted to do with your friends or family or parents, and you've been putting it off because of your work schedule, then it might be time to consider retiring earlier, or at least make it a goal to do so. There was an 85-year-long study that was conducted by Harvard University, and what they found is that the quality of our relationships has a significant impact on how happy we are. And they basically concluded that our close relationships are the key to our happiness and also health. And when we're feeling a lack of social connections or loneliness, then all these would have a negative impact on our overall well-being. So when you're working full-time, how much can you really dedicate towards your friends or your family? You might have 2 days on a weekend, but 1 day might be used for catching up on rest, or just running errands, or just spending some good old me time. So at best, you probably have 1 day to spare to actually spend some quality time with the people you care about. Something I've done personally to make the most use of my time is that I'm actually doing my weekly Costco runs with my close friends. So every weekend we would hit each other up and just do some grocery shopping together. And then when we're done, we can go to each other's homes to cook the meal together and have some time to chat and catch up. So if you're already at a point that you're financially prepared and you don't need to work, then this might be a good reason for you to retire. And the third consideration is you should focus on your health span. We always hear the term lifespan, but there's actually a difference between lifespan and health span. Lifespan is the number of years that we're expected to live, whereas health span is the number of years we're expected to live while we're still healthy and free from any illnesses. Now you have to realize that we have limited amount of years where we have the ability and the energy to do what you want to do or try. For example, like traveling to places that you've never been to, or even taking up a new hobby that your work schedule always prevented you from doing. And while we should prepare ourselves for the next 25 to 30 years, in reality, our health span is actually a lot shorter. So when we think about our retirement lifestyle and all the traveling or all the activities that we want to do, we also need to take that into account, because likely in the later years of your retirement, even if you had the money, you may not have the health or physical ability to do all the things that excites you. So make sure you create the time for yourself to enjoy the things that excite you while you still can. And the fourth sign is that when you start thinking about time, as being more important than money. Because in our working years, we often associate time with money, and we're more focused on using our time to earn as much money as possible and save as much as possible. Now, this is completely fine when we're still accumulating, and unfortunately, this mindset gets stuck in some people's heads, even when they're getting closer to their retirement age, because they always have this worry that they're not going to have enough to live a comfortable life in retirement, or they might not even know what is considered enough, because they've never really sat down and ran some calculations themselves. So what they do is they end up just keep working and keep saving because that has become their comfort zone. And many retirees have put off their retirement only to realize that they had too little time to enjoy their life with all that money they've accumulated. For example, almost every client, no matter their age, would tell us that their ideal retirement is to be able to travel more because they didn't have the time to during the working years. But the alarming thing is we've seen scenarios where clients are only a couple years into their retirement before their health started deteriorating and eventually prevented them from traveling as often as they like. Sure, there's always more things that you can buy with money, but one thing you can never buy back is your time. And the last and final consideration, of course, is whether or not you're actually financially ready. In order to answer this question, you first need to determine 3 numbers. The first number is your expenses. When you retire, you're going to have more traveling or more hobbies that you're going to take up on. But as a starting point, you can actually use your current expenses as a baseline because you're still going to have to go get groceries, food, internet, or streaming services like Netflix or Disney Plus, and also pay for your phone and utility bills. So starting with your current expenses, you can now then consider what expenses will no longer be needed after you retire. So these are things such as mortgage payments or insurance premiums, and we can minus these from our expense number. Next is you'll want to think about the activities that you'll want to do extra of during your retirement years. So in terms of the traveling or the hobbies, how much extra is that going to cost you on a yearly basis? Then from that, divide it by 12 and get the average amount that you'll need on a monthly basis. And if you want to get into the finer details to be more accurate, then be sure to factor in inflation as well when you're coming up with these numbers. Now that you figure out your expense number, the second number that we need to know is the passive income streams. So these could mean the government benefits like the CPP, OAS, or GIS, company pension plans, or rental income, or even part-time work that you're going to do during your retirement. And usually these combined can already give you a good portion for the retirement expenses that you're going to need. So for example, if we've gone through the first point and figured out that we need $5,000 for retirement, then the next step is we need to figure out how much passive income we're expecting to receive. And keep in mind though, these are the income sources outside of our investment portfolios. So for an average Canadian, assuming you've been living in Canada and working for the majority of the years between age 18 and 65, you would already receive $2,500 to $3,000 a month just from government's old age benefits alone. And many people don't realize this, that more than half of their retirement income is probably going to be covered already just from these passive income streams. But of course, if you're looking to achieve FIRE, in other words, financial independence, and retire early before you reach age 65, then you need to factor in the reduction in these benefits and the fact that you won't have access to any of them until you hit the typical retirement age. So instead, you would need to rely on the third number, which is the investment portfolio. So this number will become your goal for your investment portfolio. And this is where you can tap into for the additional amount that you need after factoring your passive income streams. A commonly used rule to calculate how much you need in your portfolio for retirement is the 4% rule. So going back to our example, if you expect $5,000 of expenses and we already have $3,000 of passive income stream, then it means we require $2,000 per month or $24,000 per year from our investment portfolio. And how the 4% rule works is that it allows us to work backwards from our $24,000 annual income number to calculate how much we need inside our portfolio to be retirement ready. So we basically take $24,000 divided by 4%, then that will give us $600,000. So this means if we have $600,000 in our investment portfolio, then we should have enough to last us for 30 years of retirement. But don't forget to factor in the taxes, because in Canada, we get taxed for our investments as well. So this part does take a little bit more work to figure out, but just know that if you're withdrawing from your TFSA, then everything's going to be tax-free. But if you're withdrawing from your RRSP or RIF, then it is subject to income taxes. So for example, if out of the $24,000 of annual income, we expect $4,000 to come from our TFSAs and $20,000 will come from our RSP and RIF, then this is how we calculate how much we need in our portfolio. So first with TFSA, because it's tax-free, so we can take the $4,000 number and just divide it by 4%, and that will give us $100,000. Then next we move on to RSP. Now this is the part that we need to factor in the taxes. So assuming if you're paying an average of 20% tax, then we would take $20,000 divided by 80%, then the number comes out to $25,000, and this is actually the number we would need to withdraw from our RSP, and $5,000 will be paid to the government as taxes, then $20,000 will be left for ourselves to spend on. So we can then use this $25,000 number and divide it by 4%, then that will give us $625,000. So that means for our portfolio goal, we would want to have $100,000 in our TFSA and $625,000 in our RSP for a combined total of $725,000 for us to be retirement ready. So this will give us a good starting point in terms of how much we would need in our portfolio. But keep in mind though, this rule is meant for someone who assumes they will withdraw the same amount every single year for 30 years, adjusted for inflation. So it's really an overly simplified calculation, but it does give an average investor a good benchmark without diving into too much numbers. So the takeaway is, don't look for a magic number or a magic formula or a rule of thumb out there. You need to know your own numbers because no one knows your ideal lifestyle more than you do. For example, if you live a very frugal lifestyle, then you might be able to rack up enough savings and retire by the age of 40. And if you want to be able to travel more often after retirement, then you might need to work and save extra hard to accumulate enough savings to allow you to have that kind of lifestyle. So if you figure out that you're financially ready, then make sure to consider the other points that we've mentioned in this video, because you might realize you actually should be retiring today instead of 5 years or 10 years later. And if you're still in the accumulation phase, then you might want to know the 8 habits that's keeping you poor. And we've made a video on that right here. Be sure to subscribe if you like our content so we can see you in the next one.